Before we begin, remember that this video is for educational purposes only and isn't insurance advice. Always consult a licensed professional for your specific needs. Insurance can be confusing, but the right information can save you thousands. Most people are paying way too much for life insurance without realizing it. Today, I'm breaking down the math between term and whole life so you can rethink guessing and start saving thousands of dollars over the life of your policy. Alright, let's start with the real-world problem. This is the part that helps you understand what is actually going on before you spend money. Think of term insurance like renting a home for a specific period, usually 10 to 30 years. You pay a small monthly fee, and if something happens during that window, your family is protected. It's designed to cover specific financial milestones like a mortgage or your children's college years. Once the term ends, the coverage stops, but you've saved a lot of money in the process. Whole life is like buying a home with a massive interest rate and a forced savings account attached. It covers you for your entire life as long as you keep paying the premiums, which is significantly higher than term. A portion of your payment goes into a cash value account that grows over time. While it sounds like a good investment, the high costs often outweigh the benefits for the average person. The biggest shock for most people is the price difference between these two options. For the same amount of coverage, a whole life policy can cost 10 to 15 times more than a term policy. This is because you aren't just paying for insurance, you're paying for the investment component and the agent's commission. If your goal is simply to protect your family's income, that extra money is often better spent elsewhere. Now let's look at why insurance as an investment is often a misleading pitch. Agents often highlight the cash value of whole life as a savings account, but it grows very slowly in the first decade. In fact, most of your early premiums go toward fees and commissions rather than building your wealth. If you cancel the policy early, you might walk away with nothing or even lose money. It takes a very long time to see any significant return on these funds. Opportunity cost is what you give up by choosing one path over another. If you took the hundreds of dollars saved by choosing term and put them into a simple index fund, you would likely end up with much more wealth. This strategy is often called buy term and invest the difference. Over 30 years, the difference in your net worth can be hundreds of thousands of dollars. If you decide to cancel a whole life policy in the first few years, you'll likely face surrender charges. These are steep fees that can wipe out any cash value you've managed to build up. Always ask for a surrender schedule before signing anything. If an agent avoids showing you this, it's a major red flag that the policy isn't in your best financial interest. Quick reminder, this isn't personal advice. Policy terms and rates vary, so always compare and consult a licensed agent. Despite the high costs, there are very specific scenarios where whole life makes sense. If your estate is worth more than the federal tax exemption, currently over $13 million, whole life can be a tool to pay estate taxes. It provides a liquid pool of cash for your heirs so they don't have to sell off property or businesses to pay the IRS. For the average person, however, this isn't a concern. If you aren't worried about multi-million-dollar taxes, you probably don't need it. If you have a child with special needs who will require financial support for their entire life, a permanent policy ensures they're cared for even after you're gone. In this case, the term never ends because the need never ends. This is a situation where the higher cost is a justifiable trade-off for the peace of mind of permanent coverage. It acts as a safety net that never expires. For people who find it impossible to save money on their own, whole life acts as a forced savings mechanism. The bill comes every month, and if you don't pay it, you lose the insurance. While the returns are lower than the market, it's better than having no savings at all. However, you should try to build a budget before relying on an expensive insurance policy to do your saving for you. Let's wrap up with a framework to help you choose the right policy for your current life stage. Start by calculating your total debt, including your mortgage, and the amount of income your family would need to replace. Most people find they need about 10 to 12 times their annual salary and coverage. Term insurance allows you to get this full amount of coverage for a price that fits into a standard monthly budget. Don't underinsure yourself just to get a permanent policy with a smaller payout. You don't have to pick just one policy. Many smart buyers ladders their term insurance. For example, you might have a 30-year policy to cover your mortgage and a 10-year policy to cover your kids until they graduate. This allows you to have high coverage when your expenses are high and lower coverage as you pay down debt, saving you a massive amount in premiums over time. When you get a quote, look closely at the may potentially versus projected values. Whole life illustrations often show rosy scenarios based on high dividends that may never happen. For term, check if the policy is level premium, meaning the price won't go up every year. Always get quotes from at least 3 different companies to ensure you aren't overpaying for the exact same coverage. That's the practical version of what matters most. The big idea is to understand the problem, compare the right details, and avoid rushing into an expensive decision without context. If this helped, like and subscribe for more practical guides that help you compare costs, understand quotes, and choose the right pro with more confidence. Don't forget to compare quotes and talk to a licensed professional before making changes. Thanks for watching. Remember, this is educational content only. Talk to a licensed insurance professional before making any coverage decisions. Subscribe for more plain English insurance guides.